I will be introducing Section 6, Topics 1 to 6 about managing risk. So first, what is risk? Risk originates from how much people are willing to pay for insurance, which determines the possibility of minimizing future financial loss. Even if insurance is not used and the insured event never occurs, money spent on insurance is not wasted. The role of insurance is risk management, not financial gain. This ensures that specific unexpected catastrophes do not result in financial ruin. Paying for premium means paying for protection against uncertainty, including emotional benefits as it reduces stress for potential disasters. Although insurance money was not used, this may have felt like money loss. In reality, you are paying for security of belongings. For example, wearing a seatbelt isn't a waste just because you don't crash. It's there just in case. Why might you need insurance? Life insurance can be crucial if you have financial dependence. For example, children, spouse, or anyone who relies on you for your income. Health insurance is always needed because it's applicable to anybody. Health issues occur unexpectedly and medical bills are expensive. Doctor visits, hospital stays, prescription drugs are all becoming more pricey. For a side note, young adults under 26 can stay under parents' health plans. But disability insurance is suggested if you depend on your income for living expenses. Young adults are more prone to accidents such as car accidents or sport injuries. Many employers actually offer disability insurance as part of their benefits. If not, you should still purchase individually. Next, we'll be talking about different insurance consumers. Here are some characteristics that influence insurance purchasing decisions. Different people may prefer different levels of security, and there is a need for health, life, and long-term care insurances as risks increase with old age. There are high-risk jobs. For example, you could be a construction worker or a firefighter, and you are much more vulnerable to injuries. There are also people who are living in disaster-prone areas such as California and Florida, and they may need insurance for floods and earthquakes. Recommended types of insurance needed by people with different characteristics. For young adults, 18 to 30, they may need renter's insurance against theft and damage. Middle-aged adults, ages 31 to 50, may need term life insurance and homeowners insurance. Older adults who are older than 51 should consider long-term care insurance, Medigap insurance. In high-risk jobs, high-risk workers should consider workers' compensation insurance. And disaster-prone areas should consider flood insurance, earthquake insurance, and other natural disaster insurances. So next, we'll be talking about mandatory insurances. Homeowners insurance is required by a lender when a homeowner takes out a mortgage. If a homeowner has insurance, the lender faces less financial risk in case of property damage. This regulation ensures a consistent standard of financial protection across the market. We also have auto liability insurance, which is a type of car insurance that does not cover your own car or injuries, just the damages or injuries that you cause to others and their property. This protects other drivers and property owners as other party may not be financially able to cover these costs. Minimum auto liability insurance, according to California DMV, is $15,000 for bodily injury or death per person, $30,000 for bodily injury or death per accident, $5,000 for property damage per accident, and starting from 2025, according to the Protect California Drivers Act, it will be $30,000 for bodily injury or death per person, $60,000 for bodily injury or death per accident, and $15,000 for property damage per accident. First, we'll be talking about lowering auto insurance premiums. Insurance premiums are generally lower for people who take steps to reduce the financial cost of losses or choose policies with larger payments. Several factors contribute to lower auto insurance premiums. For example, having a safe driving record often qualifies you for discounts. Additionally, drivers with low annual mileage are statistically less likely to be involved in accidents, which can reduce their premiums. Finally, vehicles equipped with safety features like anti-lock brakes and airbags may also qualify for discounts, as they are considered safer to insure. Next, auto insurance premiums. Taking a safe driving course is another way to lower your auto insurance premium. Completing such a course builds your credibility as a responsible driver, as it demonstrates your driving skills and proof of responsibility.
Moreover, train drivers are statistically less likely to file insurance claims, making them lower risk clients for insurers. Auto insurance with higher deductibles. Choosing an auto insurance policy with a higher deductible also has its pros and cons. On the positive side, higher deductibles reduce the insurer's financial risk, which can lead to lower premium costs. For drivers who rarely file claims, the savings on premiums may outweigh the occasional high out-of-pocket expenses. However, there are some downsides. Higher deductibles means you'll have to pay more upfront before your insurance kicks in, making it expensive if you need coverage frequently. Additionally, this option provides less financial protection for frequent claims. Healthcare insurance. Health insurance provides essential coverage for medically necessary health care. One major benefit of healthcare as an employee-provided benefit is the lower cost for employees. Employers typically cover a significant portion of the premium cost, which reduces the financial burden. Additionally, premiums for employer-sponsored plans are usually deducted from your paycheck pre-tax. This lowers your taxable income, helping you save money overall. Understanding health insurance terms is also important. A high deductible plan requires you to pay more out-of-pocket costs upfront before insurance coverage kicks in. On the other hand, low co-insurance rates means you pay for a smaller percentage of medical expenses, minimizing your out-of-pocket costs, although these plans often come with higher premiums. In contrast, high co-insurance rates require you to pay a larger share of costs, increasing out-of-pocket expenses but lowering your monthly premiums. Next, having versus not having health insurance. When you have health insurance, the cost of coverage can vary based on the type of plan. For example, the average annual premium for single coverage is around $7,470, with employers covering approximately 83% of the cost, about $6,200, leaving employees to pay around $1,270. For family coverage, the total premium averages $22,200, with employees contributing roughly $6,700. Private insurance, such as the plan from the ACA marketplace, can vary depending on factors like age, location, and income. For example, the average annual premium for a benchmark plan is approximately $5,484. Without health insurance, however, the cost can be much higher. Doctor visits typically range from $150 to $600 per visit, while emergency room visits can cost anywhere from $1,000 to $3,000. Even a short hospital stay of 3 days averages between $30,000 and $40,000, and more severe cases can easily exceed $100,000.
Next, we'll be talking about disability insurance. Disability insurance replaces income lost when a person is unable to earn the regular income due to injury or illness. So, we'll be covering different types of disability insurance. First, we have the individual policies, which are purchased directly from private insurers. These policies provide personalized coverage. They're flexible in coverage, protection regardless of employment charges, and there's a higher premium compared to group plans. There's also employee benefit plans offered by employers, and these plans often include short-term or long-term disability insurance. They're much lower cost due to employer contribution, and the coverage ends once employment is terminated. We have the Social Security Disability Insurance, the SSDI, and this federal program provides benefits to those who have a severe disability that prevents them from working for at least a year. There is zero cost to the individual, and there's a long-term coverage. There is strict eligibility requirements, so benefits may not be sufficient to cover living expenses. Disability insurance replaces income lost when a person is unable to earn their regular income due to injury or illness, as we covered. So there is worker compensation, which covers work-related injuries or illness, including temporary and permanent disability benefits. This is required by law in most states, ensuring coverage for all employees, benefits including medical care and partial wage replacement. This only applies to injuries sustained in the workplace. Benefits are usually time-limited. The California State Disability Insurance, the SDI, its temporary disability program offers a short-term benefit to those who unable to work due to non-work related injuries or illnesses, and it's provided up to 52 weeks or a year of benefits at a portion of the claimant's income. This is funded through the employee payroll deduction. An example of disability insurance scenario. So if we have a full-time employee with an annual income of $60,000 with monthly expenses of $4,500 and they have a saving of like around $10,000 and disability duration of 12 months. If they had no disability insurance, they would have no income for 12 months. The employee's savings would be gone in 3 months, leaving a $40,000 $500 left to pay, forcing all the employee to sell all their assets and possibly be left in debt. If they have a short-term disability insurance, this replaces 70% of income for up to 6 months with monthly benefits of $3,500. After 6 months, the individual has no money, relying on savings and assets to pay off $27,000. If they have long-term disability insurance, this replaces 60% of income after a 90-day waiting period. Once benefits begin, there is still a monthly shortfall of $1,500 for 9 months, so the total gap is $13,500. If they have no insurance but rely on the California State Disability Insurance, the SDI will pay 60 to 70% of wages for up to 52 weeks with a weekly cap of approximately $1,620. So the monthly max is around $6,480. So the total gap is $12,000, which is the best scenario.